Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Alex.
And I'm Jamie.
So, imagine for a second discovering that your firm is suddenly on the hook for a £19 million restitution bill.
Right.
And, it's all because a junior employee, someone you have never even met, working at a completely different partner firm, was basically allowed to check their own boss's homework.
Which is just, a terrifying prospect for any compliance officer listening to this.
Absolutely. So in today's deep dive into the source material, we are looking at exactly that, why regulatory liability is suddenly moving all the way up the corporate ladder.
Yeah, and we're also going to look at how the Financial Conduct Authority is quite literally physically kicking down doors in London right now.
Spot on. And why the Bank of England is losing sleep over a $2.5 trillion blind spot.
But before we get into the weeds of the FCA's actions, because frankly, this has been one of the most consequential weeks of regulatory enforcement in recent memory, we need to frame the broader picture.
Yeah, the macro volatility is just, well, it's dominating everything right now. As we record this on the 25th of April, 2026, the ongoing conflict in the Middle East, specifically the Iran situation, is pushing UK inflation back up.
Right. It's hitting 3.3%.
Exactly. But what is really fascinating is the underlying driver of that. It is almost entirely driven by this massive spike in diesel prices at the pump.
Because core inflation is actually edging down to 3.2%, right?
Yeah, exactly. So you have this completely fractured economic picture. And honestly, you see that exact same fracture extending straight into the heart of the cabinet right now.
Oh, absolutely. The split is incredibly public at this point. On one hand, you have Chancellor Rachel Reeves aggressively pushing for North Sea oil tiebacks.
Right, for energy security.
Exactly. And just to clarify for anyone outside the energy sector, a tieback is it's when you connect a new, smaller oil discovery to existing extraction infrastructure.
To get it online faster.
Yes, to unlock tens of millions of barrels quickly, but then literally on the exact same day, Energy Secretary Ed Miliband is out there calling any further drilling, quote, climate vandalism.
Yeah, he is essentially declaring the era of fossil fuel security completely over.
Which, regardless of where you stand on that politically, and obviously we aren't taking sides here, just reporting what the sources say, it leaves massive multi-billion-pound infrastructure projects completely frozen.
Frozen in regime risk, yeah. Look at the Rosebank and Jackdaw fields.
Right, owned by Adura, that joint venture between Shell and Equinor.
Exactly. They are just caught in the crossfire. It feels like the government is trying to drive the economy with, well, one foot slammed on the gas and the other slammed on the brake.
How does the Bank of England even set monetary policy in a blind environment like this?
It's a nightmare for them. But here's why that matters for you, our listener. This macro uncertainty, combined with that intense political friction, forms the precise backdrop for what the FCA is doing right now.
Right.
Because while the government might be paralyzed by its own internal contradictions, the FCA is actively making moves, big moves.
Yeah, and there's a real irony here, isn't there? Because while the FCA is tightening the screws on market abuse, they are also, at the same time, actively trying to eliminate their own administrative drag on the economy.
They are. Yesterday, the 24th of April, 2026, Phase 1 of the Senior Managers and Certification Regime reforms went live.
Finally.
Right. And this is a very deliberate pivot toward the FCA's secondary international competitiveness and growth objective.
Which is a mouthful, but it essentially means they want to stop being a bottleneck for hiring.
Spot on. The SM&CR has been the absolute bedrock of individual accountability in UK financial services since 2016. But if you have ever tried to hire a senior executive recently,
that's painful.
It is incredibly painful. The administrative burden had become completely unwieldy. So, Phase 1 is fundamentally about moving away from paper-heavy compliance.
Right. They are explicitly allowing digital certificates now under the certification regime, which is a nice, quick win.
It is. But the most impactful change, the thing any hiring manager or compliance officer listening right now really needs to know, is the new 12-week rule.
I am so glad they addressed this because before, you had this 12-week window to get someone into a role to cover an unexpected absence, right?
Yeah.
But you essentially needed to wait around for the regulatory approval to actually come through during that time frame.
Which totally defeated the whole purpose of urgent cover.
Exactly. But now, Under this new rule, firms simply have 12 weeks to submit the application. The candidate can actually perform the role while the determination is being made.
It's huge. And to top it off, they have extended the validity of criminal record checks. They've gone from 3 months to 6 months.
Which, I mean, that relieves massive pressure on these long, drawn-out global recruitment cycles.
Absolutely. If your HR department is onboarding international talent, extending that background check window saves weeks of logistical headaches.
And there's always a but with the FCA, right?
There is always a but.
There is a very practical bit of friction you need to prepare your teams for immediately. The FCA has confirmed that their Connect Form J will not actually be updated to reflect these new rules until the 10th of July.
Wait, so the rules apply today, but the digital infrastructure to support them isn't actually ready.
Correct. You are going to endure a very clunky legacy user experience on the portal for the next few months.
So you still have to use the old form.
Yeah, you use the old form, and then you have to attach a manual addendum explaining that you are utilizing the new 12-week rule.
I have to challenge the actual impact here then. I mean, extending a background check and giving people a few more weeks to file a manual form, is this actually reducing the compliance burden?
Or is it just kicking the can down the road?
Exactly. Are they just pushing the real problems to a hypothetical phase 2? Because it feels like a very small bandage on a very large administrative wound.
That is a completely fair critique. I mean, phase 1 is absolutely just trimming the administrative fat rather than performing deep surgery on the regime itself.
Right.
But, you cannot underestimate the cost of friction. By easing these operational bottlenecks, the FCA is signaling that the UK wants to be agile. Phase 2 will require actual legislative changes from the Treasury, which takes time.
So this is just a pragmatic down payment to show they are listening.
Exactly. So while the regulator is willing to smooth out the operational friction of bringing people into your firm, what we saw this week with Sapia Partners shows they are brutally unforgiving when it comes to who you choose to partner with.
Oh, this case is staggering.
Yeah.
We really need to break down this £19.6 million voluntary payment Sapia made this week.
Yeah, regarding their appointed representative, Virtus, which later rebranded to WealthTech.
Right. This is the definitive cautionary tale of the AR trap.
Yeah.
For anyone listening who might be unfamiliar, the appointed representative model basically allows a smaller firm to operate under the regulatory permissions of a larger, established principal firm.
Like renting a regulatory umbrella.
Exactly. And Sapia served as the principal for Virtus. And for 6 years, from 2014 to 2020, they completely failed to protect client assets under Principle 10 and the CNS rules.
We should probably ground that for the listener really quickly. The TSS rules, the client assets sourcebook, these are the strict, non-negotiable guidelines ensuring a firm keeps its own operational money completely separate from its client's money.
Right, so if the firm goes bust, the clients still have their cash.
Exactly. But here we are talking about £150 million in client funds left entirely at risk of misuse or fraud.
And I mean, the mechanism of the failure is what makes this so shocking.
Yeah.
There was a total lack of segregation of duties at Virtus. Sapia allowed the exact same staff members at the AR to initiate payments from the client money accounts and then perform the reconciliations for those exact same accounts.
They literally graded their own homework.
They did. I read they even had junior staff signing off on the reconciliations prepared by their own seniors.
Well, if you are a junior employee, you are not going to aggressively challenge your boss's reconciliations spreadsheet, are you?
Of course not. It breaks every foundational rule of financial control. The principal firm essentially abdicated its oversight entirely.
But here is the critical insight for risk teams right now. The FCA was preparing to levy a fine of £10.5 million against Sapia.
Right.
But Sapia itself simply did not have the capital to make the affected clients whole. So to fund that £19.6 million restitution and avoid the formal penalty, Sapia's parent company had to step in.
Wait, Saflux SARL?
Yes, Saflex had to foot the bill.
Wow. So going back to your umbrella analogy, if you, as the principal firm, provide the umbrella to your partner, you are fully responsible when the client gets drenched.
Exactly.
But what you are saying is that the liability doesn't stop with the person holding the umbrella.
That is the exact dynamic. The chilling message from the FCA here is that in the AR model, regulatory liability no longer stops at the principal firm's immediate balance sheet.
It extends directly up the chain to the parent company.
Right. The FCA will not tolerate passive shell principals who just, harvest compliance fees. If you rent out your regulatory permissions, your entire corporate structure is on the hook.
Which is terrifying when you realize Sepia's failure was a breakdown in basic, manual, human checks, spreadsheets, and signatures.
Yeah.
But the reality is the FCA is already preparing for a financial system where humans aren't doing the checking at all.
Right, the AI stuff.
Yeah, over at UK FinTech Week, the FCA announced the second cohort for its AI live testing. And looking at the names, this is clearly moved from a cute sandbox experiment to industrial-scale deployment.
We are looking at Tier 1 heavyweights joining this cohort, aren't we?
Massive names. Barclays, Lloyds, specifically their Scottish Widows division, UBS, and Experian.
Wow.
Alongside some incredibly sharp fintechs like Coadjute and Palindrome. And the technology profile they are testing has fundamentally shifted. We are moving past simple, large language models.
Okay.
This cohort is actively testing agentic AI, small language models, and neurosymbolic AI.
Wait, I need to stop you there because that term is getting thrown around a lot.
Yeah.
Neurosymbolic AI.
Yeah.
I thought the whole financial industry was just throwing larger and larger language models at the wall to see what sticks. What makes a neurosymbolic system different?
Well, it is designed specifically to fix the hallucination problem. You know how an LLM might hallucinate a fake company name or a fake transaction?
Yeah, because it is just guessing the next word based on probability, right?
Exactly. But a neurosymbolic system combines the pattern recognition of a neural network with the hard, deterministic logic of traditional symbolic AI.
So, it runs that probabilistic guess against a hard-coded, rules-based database of actual registered companies or compliance rules.
Spot on.
And if it's not in the database, the logic just blocks the hallucination.
Precisely. It provides a mathematical certainty that pure LLMs lack. And these banks are deploying this for agentic payments and automated anti-money laundering detection.
But, that raises a massive red flag for me.
How so?
We are moving from AI as a co-pilot that merely drafts an email or suggests course of action to an autopilot that acts autonomously on moving money.
Right.
If this neurosymbolic AI is executing payments at machine speed, how does a human compliance officer actually audit an intelligence that works faster than human comprehension?
That is the existential question of this decade for regulators. And the FCA's response to this cohort is incredibly revealing.
What are they doing?
They have partnered with Advi, a London-based specialist in automated AI assurance. The regulator fully understands that a team of humans with clipboards cannot monitor agentic AI in real time.
Oh, wow. So we are entering an era of AI watching AI.
Exactly. The assurance mechanisms, the auditors, have to be as automated, intelligent, and rapid as the execution models themselves.
So you essentially have an adversarial AI constantly testing the execution AI to ensure it stays within the regulatory guardrails.
Exactly that.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
So, the underlying technology is clearly moving at warp speed. But the Bank of England is waving a massive red flag, warning that the markets funding all this rapid innovation might be driving straight off a cliff.
Yeah, we heard a highly unusual speech from Bank of England Deputy Governor Sarah Breeden this week.
It was remarkably blunt. If you follow central bank communications, they usually whisper about market corrections in highly caveated academic language.
They never want to be the cause of a panic.
Exactly. But Breeden explicitly stated that global stock markets are currently overvalued and completely ignoring glaring macroeconomic risks.
And it wasn't just broad stock market valuations she was worried about, was it?
No, her specific anxiety, the thing keeping Threadneedle Street awake at night, is the $2.5 trillion shadow banking and private credit market.
Which is just a staggering number.
It's massive, and it has grown from virtually nothing over the last 2 decades to this massive, untested blind spot.
Because it has never been stress tested at this scale,
Right.
nor with this degree of complexity and deep interconnection with the broader financial system.
Exactly. The Bank of England is not just preparing for a standard banking crisis anymore. They are explicitly wargaming a private credit crunch.
Which, that requires a totally different playbook.
How so?
Well, think about it this way. Traditional banking is like a massive public scoring tool with lifeguards. The Bank of England is the ultimate lifeguard. If the water gets too rough, They have the explicit authority and the tools to calm it down or bail it out.
Right.
But private credit is like a massive interconnected network of private backyard pools. If they all spring a leak at once, the central bank doesn't have the explicit authority or the hoses to refill them.
That is the precise systemic risk. If confidence in private credit evaporates at the exact same time as a macro shock hits, say, a sudden escalation in the Middle East energy markets we discussed earlier, the systemic disruption could be severe.
Because the central bank lacks the traditional levers to intervene.
Exactly. They cannot just inject liquidity into shadow banks the way they do with high street institutions.
And what is fascinating is that while the Bank of England is watching that $2.5 trillion wholesale private credit space, the FCA is simultaneously fighting a messy hand-to-hand battle in the retail credit space.
The motor finance scheme.
Yes, the £7.5 billion retail credit space. Let's look at the twin consumer duty stories completely disrupting the motor finance redress scheme this week.
The FCA designed this centralized redress scheme specifically to bypass the courts, didn't they?
They did. The goal is to offer a free, fast, and fair route for consumers who were missold discretionary commission arrangements by car dealers. But the scheme is currently facing attacks on two completely different fronts. First, a consumer group called Consumer Voice, which is backed by the law firm Cormax, is launching a formal legal challenge at the upper tribunal.
What are they arguing?
They argue the FCA's scheme is far too narrow and unfairly excludes 4.7 million missold agreements.
Wow. 4.7 million.
Yeah.
And on the second front?
Well, on the second front, the FCA has issued a stark public warning directly to claims management companies, or CMCs and law firms. The regulator is calling them out for retaining up to 36% of the compensation payouts.
36%. I mean, I have to ask, aren't these CMCs essentially becoming the new mis-sellers in this scenario?
Right.
They were siphoning off a third of the redress from a scheme that was specifically built by the regulator to be free for the consumer.
It is a profound irony, and it perfectly illustrates the challenge of the consumer duty. The FCA stepped in to fix a market failure where consumers were being exploited by hidden dealer commissions. And the regulatory solution is now being hijacked by intermediaries extracting massive legal fees.
It's unbelievable.
The FCA is practically begging law firms to give clients the option of exiting their contracts and waiving these fees. They are warning that these legal challenges at the tribunal are just delaying £7.5 billion from getting back into people's pockets at a time when, household bills and diesel prices are rising.
That theme of intermediary exploitation leads us right